Welcome to Debt Matters.
Great to be here.
So we're going to get into something today that feels like, well, a real pressure point in the UK economy right now.
hmm It's this collision, really. On one side, you have a labor market that's clearly cooling off.
And on the other, borrowing costs are still incredibly high for the average person.
Exactly. And when those two forces meet, you start to see real changes in how households manage their money and, how debt gets collected.
It's almost like a warning light is flashing on the dashboard of the economy.
That's a very good way of putting it. These job numbers, they are that warning light because you have this rise in unemployment happening at the exact same time we're seeing record costs for things like credit cards.
And our goal here is to really connect those two things, to draw a line from the big macroeconomic headlines, Bank of England rates, jobless figures, to what that actually means on the ground.
For people with bills to pay and for the teams who have to manage those accounts when things get difficult, it's a very predictable sequence, really. When jobs become less secure and wages stagnate, arrears will follow.
But the data we're seeing now suggests the group of people who simply can't pay might be about to grow
Yeah,
and grow quite quickly.
it does. The conditions are certainly there.
Okay, so let's start with that macro picture then.
Yay.
The big numbers. The unemployment data for the fourth quarter of 2025. What did that tell us?
It told us the UK rate has now hit 5.2%.
5.2. And just to put that in context,
That's the highest it's been since early 2021. So we've undone a lot of the post-pandemic recovery on that front.
and that's the headline figure. But it isn't just about people losing jobs. It's also about pay for those who are still in work, isn't it?
Absolutely. That's the other side of the squeeze. We're seeing a definite cooling of wage growth. And when your pay packet isn't keeping up with your costs or even just your expectations, that's when the monthly budget starts to fray at the edges.
And digging into those unemployment numbers a bit more, there's one particular group that's being hit harder than most.
Yes, the youth demographic, specifically 18 to 24-year-olds.
The unemployment rate for that group has reached, what, 14%?
14%, which is, that's a 5-year high. And actually, if you take the pandemic years out of the equation, it's a joint 10-year high. It's a really stark figure.
Why is that group so vulnerable in this specific economic climate?
Well, there are a few sort of structural reasons for it. First, they just have thinner savings buffers. They haven't had the years in the workforce to build up a cushion
So an income shock hits them much faster.
instantly. Then you have their exposure to rent. They're far more likely to be renting, and rent is one of those non-negotiable costs that has been rising very steeply.
Right. And then there's the types of credit they use.
We see a much higher reliance on things like overdrafts, buy now, pay later products, and of course credit cards. These are often the first lines of credit they can access, but they can also be the most precarious.
So the financial system, the wider market, it sees all this data job losses, slow wage growth, and the reaction is pretty predictable.
Oh, it's swift. All eyes immediately turn to the Bank of England. The thinking is the economy is slowing, they must step in.
And the expectation is for a rate cut.
It is. The money markets are pricing in about a 75% chance that we'll see a rate cut to 3.5% in March.
And this is the crucial part, that creates a strange sort of paradox for consumers, doesn't it?
A huge paradox. This is where the real credit crunch bites. Because while the central bank is talking about making borrowing cheaper at a high level, the reality for you and me is moving in the complete opposite direction.
Let's talk about that specific number. The average purchase APR on credit cards that was reported for February,
It came in at 35.8%.
35.8%.
It's the highest level since records began back in June 2006. So just think about that for a second. The official bank rate might be about to fall, but the actual cost of carrying debt on your credit card has never been higher.
It's like pouring fuel on a fire, isn't it? It just acts as a massive accelerant on any existing debt.
A perfect accelerant. A balance that might have been manageable at 20% becomes unmanageable very quickly at nearly 36%. Your minimum payments take a much bigger bite out of your income.
And a small missed payment can spiral into a real delinquency cycle so much faster.
It really can. And all of this, the job insecurity and these high borrowing costs, it forces a change in behavior, a very rational change.
The payment hierarchy shifts.
It does. We call it priority bills first behavior. If you're worried about your job or you just lost it, what do you pay first?
The rent, the mortgage, your council tax, the gas and electric.
The things that keep a roof over your head and the lights on? Precisely. And the direct consequence of that is that unsecured credit. It just drops right to the bottom of the list. Repaying the credit card or the personal loan becomes discretionary. A nice to do, not a must do.
So if you're on the other side of that, if you're in collections, this changes everything. You can't just use the same old playbook.
The playbook from a couple of years ago, from a low-rate, high-employment world, it's completely obsolete. You have to adapt.
And the key is moving earlier, I assume.
You have to. The whole strategy shifts from escalation to engagement. You can't afford to wait and see if the problem fixes itself, because in this environment, it probably won't.
So let's walk through what that new timeline looks like. In that first week of a missed payment, say day 1 to day 7, what's the approach?
It's all about multi-channel nudges, gentle reminders. And the key thing is the tone. It's all about presenting options, not making threats. You're trying to open a door to a conversation before the problem gets any bigger.
Okay, and if that doesn't work, you move into the next phase, day 8 to 21.
That's when you have to pivot towards a more structured affordability conversation. You need to get to a clear decision point, a kind of matrix. Can the customer repay? Do they need a pause? Or do they need to provide evidence for a longer-term plan?
Right, but getting that information, that data from the borrower, can be difficult. You can't send them a massive form to fill out.
No, absolutely not. You have to make it simple. Tighten the affordability capture down to the absolute essentials. You need speed and you need clarity.
So what are those essential questions?
Really, you can boil it down to 3 things. 1,
Right.
has your employment status changed in the last 90 days? Simple yes or no.
Okay.
2, what's the trend with your housing costs? Are they up, flat, or down? It gives you a sense of the pressure they're under.
And the third.
And this is the most important one. Do you have any priority arrears? Are you behind on your rent, your mortgage, your council tax?
Because if the answer to that is yes, you know they definitely can't afford to pay you.
That's the red flag. If they can't pay their rent, they can't pay their credit card. It's that simple. And once you have that data, you might need to move away from traditional payment plans.
Get towards something different. You call it a stabilization plan.
Yes,
Right.
this is a big shift. A traditional plan might be for 12, 24 months.
And this is shorter.
Much shorter, just 30 to 60 days. The logic is that in a weakening labor market, setting someone up on a long-term plan is often setting them up to fail. It assumes a stability in their income that just isn't there.
That makes sense. A lot can change in a year.
Exactly. A short plan, a stabilization plan, is different. It's focused on re-engagement, on habit formation. Just get them paying something, even a very small amount, to keep the connection open. Then you reassess in 2 months when the picture might be clearer.
It keeps the lines of communication open, which feels like the most important thing.
It's everything.
Now, let's circle back to that youth demographic, the 18 to 24s, with that 14% unemployment rate. How do strategies need to adapt specifically for them?
The tone is paramount. You simply cannot use an aggressive or overly formal tone. It won't work. Tactically, you need to think about what suits their financial lives.
So things like smaller, more frequent payments.
Yes, that can be very effective. It might align better with gig economy work or just how they manage their cash flow week to week rather than month to month.
And I imagine the channel is key. They'd probably rather use an app than pick up the phone.
Absolutely. Prioritizing app-based self-serve options is a must. Let them sort it out on their terms at their own time. And another thing is crucial.
Which is?
You have to signpost to free debt advice very, very early in the process. It's not a last resort. It protects the customer outcome, it shows you're acting responsibly, and frankly, it reduces complaints down the line.
Okay, now let's flip to the other end of the scale. What about B2B, business-to-business collections? What are the implications there?
The core rule is even simpler in B2B. Do not wait. In this kind of climate, waiting for an invoice to be 60 or 90 days past due is just far too risky.
So you need triggers to act on much earlier.
Yes. Simple things. Confirm purchase orders and check for any dispute status really early on. Don't wait for them to tell you there's a problem. Reissue statements faster. And you have to watch for the silent accounts.
Explain that. Why is silence so important?
In the B2B world, silence is often the loudest warning sign you'll get. A business that suddenly stops responding to emails or calls. That's a huge red flag. Silence very often precedes insolvency. You have to escalate that immediately.
So as we sort of look forward over the next few months, what are the key indicators we should all be watching?
On a practical level, you need to monitor payment plans very closely. Expect to see a higher rate of what we call plan breaks, missed installments. That's your first sign of trouble.
And what about the conversations themselves, the hardship signals?
You'll hear certain phrases more often, people saying they're in between roles or that their hours have been reduced. These are subtle but clear signs of income shock.
Which really underlines the need to train agents and systems to spot this stuff early, right? You can't wait until month 3 to find out someone lost their job 2 months ago.
You can't. That initial conversation is your chance to triage vulnerability. It has to be done on day 1, not day 90.
And finally, let's touch on that potential rate cut again. It sounds like good news, but there's a catch.
There's the rate cut lag. That's the catch. Even if the Bank of England does cut rates to 3.5%, borrowers are always the last to feel the benefit. Lenders might adjust their risk appetite or settlement offers, but that cash flow relief for the average person, it takes a long time to filter through the system.
It's not an instant fix.
Not at all.
So really, the whole definition of what a successful collection is has to shift in a downturn like this. It's not always about getting the full payment immediately.
That's the core message. Success becomes about maintaining engagement. It becomes about stabilization. It's about keeping them talking, keeping them on a plan, however small.
Riding out the storm with them, in a way.
That's it, exactly. Ride out the storm together.
That wraps up this episode of Debt Matters. Thank you for listening.